Well, good afternoon, everyone. Thank you for coming up after the inspiring plenary downstairs with President Bill Clinton to transition to a more practical conversation, perhaps, around blended finance. Before I introduce our panelists and we get into the hard discussion, I just want to take a few moments to set the context around our conversation this afternoon. Blended finance in the conversation really is a means to the end. And really what we're talking about here is getting the right capital into communities. Many of us, all of us, I think now, are very aware that we don't have enough philanthropy and government resources to really address some of the complex problems in our globe. And so really blended finance at the heart of it is really thinking about how do we crowd in private capital and crowd in more resources to address these issues. Blended finance, what is it very basically? Generally, blended finance is used more in emerging and frontier markets. It's also, though, very prevalent here in the US. We sometimes call it stacked capital. And in this conversation, this is a global one. So at the panel, we'll be talking about a transaction in the US going deep into the details of the structuring. And then we'll be turning to the audience and hearing some international examples. And as we have a discussion in the second half of our session, really it's for us to share and discuss transactions at a global level, whether in the US or abroad. Simply, the structuring of blended finance is generally having some soft capital at the base of a structure, that soft capital often being philanthropic or development capital sources. And that capital is acting as a way to de-risk and therefore crowd in more commercial capital that perhaps is more risk averse. And then just the last point I want to touch on before we get in conversation is, why is this conversation so important now, the urgency? And I was really warmed over the last 2 days. I've heard urgency in a few conversations, either around the environment or the other social issues that we've been discussing, that this is a moment where we need to act quickly and really think about how to scale some of the solutions we have. And the urgency around blended finance, I believe, can be seen from a few different lenses. One from the borrower. There's many entrepreneurs, social enterprises, or perhaps intermediaries. Those are platforms that are then on lending to organizations in communities that have been struggling to raise impact capital in an imperfect market. And the opportunity with blended finance is the braiding of many sources to create more ease and accessibility to borrowers to find capital. And therefore, at the end, I would argue or posit, really be able to focus on the work they do best, really lower their operating costs, their transaction cost, and really get the work done. From a systems lens, blended finance has a promise of scale. I heard very poignantly in the COP21 conversation yesterday in this room that if we can really get more finance into proven solutions, we can actually change the system today and have different outcomes than predicted in 5 years. And then from the lens of the investor, I believe blended finance has a great opportunity to provide on-ramps, easy, accessible ways for investors to engage, institutions to engage in impact investing or investing that's offering social and financial return. And right now, it's a little bit murky, a little bit of a struggle to place assets into these opportunities. So with all that said, just before I turn to the panel, if we can quantify in dollar terms this urgency, from the World Economic Forum site, meeting the Sustainable Development Goals will require an additional $2.5 trillion per year, an additional $13.5 trillion to implement the COP21 Paris Climate Accord. I think that says it. We need to figure out how to get more finance, more money into communities. And blended finance is simply one tool to explore. So, turning to my left, we have Kimberly Cornett. She is the Managing Director of the Social Investment Practice at Kresge Foundation. There, Kimberly is working closely with the program teams to make capital available to organizations working on key strategic priorities of the foundation. And then to her left is Audrey Choi. And Audrey is the CEO of the Institute for Sustainable Investing and Managing Director and Global Head of Finance at Morgan Stanley. In this role, Audrey oversees the firm's effort to support resilient communities and promote economic opportunity and global sustainability through the capital markets. So moving into discussion, we'll take about 20 minutes up here to explore one particular transaction and more broadly blended finance, and then we'll be moving into, I hope, a more round table, since we have a smaller group conversation. So Audrey, to get us started, could you describe the Healthy Futures Fund, which is the transaction that you participated in, I believe was 2011? Initially?
13 it actually
13,
closed,
okay.
15 was round 2.
Oh, 15 was round 2, thank you. And a little bit about how it came to be, the problem was looking to solve, and then if you could just share too some of the impacts to date.
Great. Thanks so much, Jen, and it's great to be here. So the Healthy Futures Fund is really actually a brainchild of Kimberly's, and so briefly, it's a partnership. I think it was one of the most important things. It's a partnership between Morgan Stanley, the Kresge Foundation, the Local Initiative Support Corporation, and the public sector, the government. And I think that one of the most important things as to why it's a helpful example to talk about today is that it truly would not work if it didn't have public sector, community organizations in the form of LISC, and private sector capital, as well as government policy programs that underpin investments in low-income housing and healthcare. And the origin of it was actually that, shortly after the Affordable Care Act was passed, Kimberly actually came to me and said, there's got to be something here that we can do. Because we all know that, that it's no surprise that low-income communities in America, surprise, surprise, have poor health outcomes than affluent communities. And frankly, we all also know why that happens, right? I mean, that happens because in poor communities, it's often very difficult to access quality, affordable care. So even if you have insurance that entitles you to that affordable quality care, if it's going to take you 2 buses and a taxi, and this was before Uber, so yes, today it might take you 1 Uber pool ride, but back then, to get primary care, you were likely not going to get primary care, and you were going to wait until an ambulance took you to the emergency room. So we kind of knew that it was no mystery. We knew that the public sector was there providing various different policy programs, whether it was the low-income housing tax credit to support affordable housing construction, whether it was the new market tax credit program to try to support commercial enterprises in low-income areas, or whether it was the Affordable Care Act and the subsidies being provided for federally qualified healthcare centers. But the problem was that all of these things were being put down in silos and sort of independently solved for. And what we really needed to get to was, how do you bring that together so it's a solution for low-income community where they live and work and where they need the care. And so, Kimberly really sort of kicked off a process of, how do we figure this out? How do we get that right basket of capital together that's going to be layered appropriately with philanthropy, nonprofit, public sector, private sector? And so ultimately what we launched in 2013 was a $100 million initiative, the Healthy Futures Fund, that specifically said it was going to invest in affordable housing, if and only if that affordable housing was really tied integrally to the provision of affordable health care. Over the course of the first 2 years, that $100 million went to about helped establish 5 federally qualified healthcare clinics that have serve about 96,000 people per year, and led to the construction of about 415, I believe, housing units. So that in 2015, we were able to re-up, and all the partners, LISC and Kresge and Morgan Stanley, were able to do a second 2.0 of another $100 million, and again, that will have the projected impact of about another 450 affordable housing units, 5 or 6 federally qualified healthcare centers that should be able to serve on average 100,000 patients per year.
And Audrey, if you're to put your Morgan Stanley hat on, why did you find this fund appealing? Mm-hmm. Why, as an investor, did this fund, not just once, but twice,
right,
did this really work for you?
So look, I think it has to be said, if we were just looking for the single highest short-term returning use of a dollar, this would not have been our choice, right? But I think there's many transactions that an investor who's focused on simply optimizing a near-term rate of return would probably want to choose instead. I think for us, this transaction in particular, this investment was significant because what we were really interested in was trying to help figure out how do we actually leverage capital in conjunction with philanthropy and public policy goals to achieve an investment that actually does qualify as an investment, that is attractive from a risk component, that is going to have a sustainable economic return, that frankly, I think part of our mission is to help really, and especially with the first fund, was to really try to have the opportunity to test the notion that you could invest investor capital in a way that is going to be economically sustainable, solvent, safe, sound, and that it's going to be able to make a return. Again, perhaps not the optimized short-term return. I think that one of the reasons that we were so excited to be able to re-up with it is that once you've figured out that structure where you are able to partner efficiently with philanthropy, with government, with nonprofit, that's the hard part, right? And if you can then actually go with those trusted partners again, that you can really help show that there is a way to scale this and to bring these solutions rapidly. And I would say finally, I think that the thing that I think really hope that will ultimately this will prove out is it's not just the case that an investment can be a good investment and also allow good outcomes to happen at the same time. Ideally, it's really that we can prove the case that a good financial investment that is fundamentally baking in how do you strengthen the community around it actually ends up giving back a positive benefit to the investor in the form of a more stable community where families are more stable, able to survive crises, therefore don't miss rent, don't have to move out, you don't have vacancy, reletting and other expenses, you have a more healthy community with lower maintenance costs, and that really you end up having a virtuous cycle that is good for the investor as well as the community.
Right. And going back, though, Kimberly, to the beginning of where Audrey said, the investment worked for us, the structure worked for us. Can you bring us into a little bit more of the detail of the structure? And if you're, going back to 2013, so you have to go back in time, memory can fail. But can you remember kind of the iterations and the process also that you had to go through a little bit to find that right balance between risk return for someone like Audrey and then the structure and in the detail that came to be?
Well, when Audrey tells it now, it sounds so neat and tidy. And it wasn't like that at all, I promise you. But I think I want to say one thing that is one of those qualitative factors about Healthy Futures that sometimes gets overlooked, but I think is actually very critical to these structures that we call blended finance, which is really relationships across institutions. And so had there not been professional relationships between Kresge and Morgan Stanley and Lisk and Kresge and Herseth, this would have likely not come together because there needed to be a high degree of comfort and trust and patience at the table while we cooked this thing. So I think from the Kresge perspective, what was happening in 2012, 2013 was that our program staff was making a lot of grants to federally qualified health centers as the Affordable Care Act was being rolled out, and as federally qualified health centers were expected to see just a wave of new people coming to their doors, and many of them were operating in physically obsolete health centers that just simply weren't built to take that kind of capacity. And it simply outstripped the amount of grant resources that we had available and really that the public sector had too. So we honed in on that this was really a financeable business. And what Morgan Stanley had, which made them a unique partner and quickly identifiable, was that they were both a purchaser of low-income housing tax credits and new market tax credits. And LISC at that time was really the only intermediary that was actually a syndicator of both of those credits. So we actually didn't have to go looking far and wide for our partners. We had the relationships, they were the buyer, and LISC had the credits. And so then it was really just coming up with that formula that worked for everybody, which did take some time. In some ways, I hesitate to talk about Healthy Futures because it was one of the first transactions that I worked on, and it has been really just a sweet story. The money got out, it got invested, we had good partners at the table. The health in all things has really come into its own in a way that I could not have expected, even over the course of 3 years. I financed affordable housing for a decade. We didn't talk about health. And in this short amount of time, we've really seen health very much become present in a variety of community development activities. I think Healthy Futures was really an at-scale example which helped that, but we really did ride a wave. But the other reason that I want to mention why it's so sweet is because in the second round of Healthy Futures, we were able to reduce our participation significantly. We were able to bring in another investor to play the role of a subordinate lender. And for me, that really is the capstone of almost everything we do, which is, can we demonstrate to the investor that they can operate in a market with less protection, and so I can take our very precious resources, which can tolerate risk and term and rate, and go off and do something else.
Wonderful. And just one little added piece of the story, if you could. Can you talk a little bit about internally? You had to bring this transaction up through your internal framework and decision makers. I'm assuming it was one of the first blended finance transactions they saw, or if not, maybe it was unique in thinking about how to use Kresge's capital in this way. How was that process, and how did you build consensus that this was efficient, a wise way to use the capital?
Well, I think it was one of the first at-scale deals that we had participated in, and the foundation was still in the early days of really acknowledging that we could be a full continuum investor. We could use our grants for things that did not have an opportunity for repayment, and we had a whole suite of other capital tools. And so it was kind of our first step out onto that high wire. We had also never contemplated credit enhancing a financial institution, which today we do with frequency and comfort, but there was a philosophical discussion about, is that the right thing to be doing with charitable resources? We believe that it is. The foundation, under its $350 million commitment, has 4 goals. One of those is to leverage $1 billion from other investors. We're going to hit that goal next year. So we're now very happy when we can apply prudent business terms to credit enhance other partners when they can bring capital to things that we care about.
And so picking up of 2 things you've said, Audrey, this transaction for you, at the end of the day, it's a better community and everyone wins. And then also testing the notion and then efficient use of capital. If you bring this all together and we think about just now blended finance transactions in general, Audrey, why do you think we're not seeing more of them, or the amount we need to really start to address some of the capital needs in communities and really in the environment challenges in our communities?
Well, I think the encouraging news is that we are starting to see more of them, right? And I think there is more and more momentum around this, more and more people thinking about how do you really layer this. But, I think some of the themes that Kimberly raised really point to sort of why maybe it hasn't yet been all of the floodgates opening at once, which is, it does take a bit more complexity. It takes setting up some structures that, that aren't normal. And so, building those roads kind of the first time are always more challenging. And I think it's just as Kimberly was saying that, it was a bit unusual for a philanthropy to think about credit enhancing a financial institution. Again, I think, there was definitely an education process, for us internally about what does this mean to partner in this way, to have these kinds of this sort of different structure that, maybe a traditional analyst of a real estate deal wouldn't normally see, right? And again, this program was actually the first. I mean, it's really interesting. So the low-income housing tax credit, federal program that's been around for decades. This was the first time that you'd ever actually combined the low-income housing tax credit, the new market tax credit, and this program from HHS around federally qualified healthcare centers. And so you had an entity outside the U.S. government actually, bring, or a collaborative outside the U.S. government bring together 3 different government programs, right? Which again, even within the government, right, you have the Health and Human Services Department focusing on healthcare, and you have Treasury focusing on housing, and then you have HUD programs focusing on other parts of housing. And so the ability to kind of weave all those things through. And then I think the other thing that I think just from a sort of a cultural perspective or even a linguistic definition, if you will, is, I think for a long time we've been talking collectively about public-private partnerships. And people also say, oh, public-private partnerships, it's like it's like the silver bullet but then if you dissect them, most people are actually not that happy with their public-private partnerships, right? At the end of the day, someone's like, we got a little arm twisted into that one. And when you kind of, pull it apart, you realize that a lot of those public-private partnerships we've had in the past was kind of a little bit of a like, okay, let's barn raise, let's come around the table and everybody kick in. And it all kind of goes into the pot. And we stir it up, and we hope that there's more in the pot because more people have kicked something into the pot. As opposed to, I think, what we spent a lot of time doing was very carefully structuring how do you layer this, right? Which is why I think you get to this sense of a capital stack as opposed to a capital swirl, right? That you need that philanthropic layer, and you have to think, what does the philanthropy want as its return? It wants impact on healthcare. What does the government program need as its return? And then you finally get to something where you can optimize the ability for everyone to do what actually comes naturally. Right, and so then I think that's how. And I think the more people get used to that, the more people will start thinking about different structures like that, and the more we can just say, "Oh yeah, that worked. Let's do it again." You start seeing more and more.
So curious, do you have a lot of these coming across your desk now in the day-to-day work you do? I'm assuming, if there was 5 of them there, you'd be excited to look at all 5 and see if you can move capital into them. What's the balance? Are they sitting on your desk, or do you not have the capital? Where supply demand? Tell me a little bit just from your perspective.
In a lot of ways, I think this is, I think there's certainly a number of opportunities that present themselves, but I would say the huge stack of requests and proposals is probably on Kimberly's desk, right? Because in most of these things, we often talk about the but-for element, right? There's all these opportunities that could be interesting for private capital to come into, but for a little critical bit of philanthropy or some other thing to form that that layer of protection and the enabling. And so that sort of but-for element needs to really be able to be the catalyst in many places to unlock this.
Yeah. And so, Kimberly, to that point, you hinted that you have a new expanded strategy at Kresge Foundation, $350 million. I didn't inflate it, right? Yeah. But I was actually stunned personally to hear you've almost leveraged it all, it sounds like, or you're close to earmarking it all. Okay, so that's exciting. But back to Audrey's point also, now what? How does blended finance play out in the future of Kresge Foundation when there is this limited capacity at the end of the day?
Well, I mean, I should say that we've gotten to that number fairly quickly, in part because we completed a blended finance transaction that actually was kind of born out of CGI, called Detroit Home Mortgage, which closed at the end of last year. That was a $100 million transaction for single-family mortgages in Detroit. We have 6 bank partners in that transaction, which provides non-conforming financing to conforming borrowers who are trying to finance renovations for single-family homes in Detroit. So that moved us up towards our goal significantly. For us, I think these kinds of transactions, they are hard fought for and not every day, because it takes a lot of the right people with the right kinds of capital with a shared interest on a single issue. And that's not always easy to find. I would say that the big stack of papers on our desk that move, unfortunately, away fairly quickly are transactions that really come to us with a structural gap, not really a capital barrier. And that's the differentiation for us. $350 million is a drop in the bucket, and we have to figure out how to allocate those resources. So we're really looking for transactions where we believe there's promise for replication. We believe that over time we can influence another investors' behavior so that we can go away. We're looking for transactions that hit cities and low-income people. So, unfortunately, when you take all those parameters, you winnow down to a fairly short list, and then you've got to find a viable transaction. So they're not around every corner. We have balanced that by trying to make available to CDFIs and development finance agencies a very basic loan product that just is about capitalizing intermediaries that are important in the ecosystems of the programs that we work on, where the standard of what we're trying to achieve in terms of impact is not as high, but it's more about equipping the actors in the communities that are really qualified to assess risk and opportunity every day.
Right.
And can I just say just two quick things? I think also we just have to underscore the importance of public policy programs, right? I mean, the Healthy Futures Fund would not have been possible without the programs that are in place from the federal government specifically to catalyze these things. And so, I think that we really need to remember the importance of public policy that is devoted to this that we can leverage in. The one really hopeful thing that I would say, though, and I think to your point, why we are optimistic that there will be a growing opportunity set out there is because we definitely see the demand from investors growing, right? And so, just as one data point, as an example, the Institute for Sustainable Investing, we did a poll of 1,000 investors, American investors, so U.S. equity, U.S. active investors, and we found that 71% of them said that they were interested, right, in sustainable investing. And what was really interesting is you actually further broke down that 71% who said they wanted to start aligning their investing with their values. You actually saw a really interesting demographic breakdown where it was 60-some% of men said they were interested in it, 76% of women, and 84% of millennials. And so as you see this sort of wealth transfer to the next generation who really believes in living their values in sort of all sorts of ways, I think you're seeing more and more desire for that. The last thing I was just about millennials is, we also polled them about what they think about things and how they think. And what's fascinating about millennials is that unlike other generations who sort of feel like there's work and finance and profits over here, and then there's charity and impact over here, millennials were 3 times more likely to choose their job if they felt that the job had a positive sustainability component to it. They were twice as likely to check products for sustainable sourcing and buy their products as a result of it. But especially interestingly, they carry that right over to investment. And so they were twice as likely to buy a stock or a mutual fund or an investment strategy if it contained sustainability as part of the fundamental driver of value creation. And they were also twice as likely to walk away from an investment if it didn't align. So I think, the generation that focuses on knowing everything instantly is also focused on caring about everything that they know. And I think it's going to drive more and more demand for people to say, how do we do this at scale, easily, from our iPhones or from whatever smartphone we have in our hands.
And picking up then on a few threads, the lack of soft capital, one of the limiting factors in these blended finance vehicles, as well as the promise of replication, which Kimberly mentioned. As a practitioner in the field, putting on my Calvert Foundation hat, another blended finance vehicle I'll just share with the group is one that I worked with in collaboration with MacArthur Foundation and Chicago Community Trust over the last 2 years. It launched earlier this year in May under the title or the naming of Benefit Chicago. And another blended finance vehicle that I share because it had some unique features, and I think we're looking for those. What are the kind of features that we can replicate to perhaps unlock more soft capital or to bring in more investor capital with ease? And in Benefit Chicago, one of the desires was donor-advised funds. How can we unlock that asset, which is a philanthropic really resource? It is donated at the time a client sets up a donor-advised fund and then sits and is traditionally today invested in the market. public equity and debt in a very balanced portfolio until that donor makes the election to donate it to a nonprofit or a charitable organization. What we saw was the opportunity to think about those donor-advised fund assets when they were in rest, and could we unlock them and have them really participate in community and social needs. And so with that objective and the enlightened approach, I would say, of both MacArthur Foundation and Chicago Community Trust, we collaborated and created a blended finance vehicle where MacArthur Foundation put $50 million of their capital in a subordinate position in a structure fund, really thinking about their capital as market making, as capital to be catalytic, to crowd in private capital. And then on top of their capital is $50 million of capital that Calvert Foundation is raising through the issuance of our community investment note. It is a note we have issued for 20 years. It is a fixed income product that retail institutions can purchase at 1, 3, 5, 10, 15-year increments for a rate of return of 1 to 4%. So it looks like a fixed income investment. They are making that investment as well. Very uniquely, we also got this note, our community investment note, on the Chicago Community Trust Donor Advised Fund platform. So there we have the ability now for the DAF clients to invest while their assets are sitting or at rest in the note, and therefore ultimately be invested in the community of Chicago. So this whole structure, $100 million, ultimately will be deployed in Chicago in equity and debt in all sorts of community needs, from food systems to affordable housing to community development finance. And very honestly, we hope that it can grow to $500 million. We did a needs assessment of that community to learn that really the gap there is about $500 million. But kind of like there was a round 1 and 2 in the Healthy Futures Fund, the structuring of this vehicle was very thoughtfully created at the start to grow as community need grows. And really the fuel to that growth will be the private capital and the donor-advised fund money that will come in, hopefully in a really easy and accessible way for those investors at the top of that structured finance. So just another kind of vehicle to think about as we look to examples. There's one other in the audience I wanted to turn to. We've been talking a lot about U.S. and domestic opportunities up in the stage. I wanted to introduce James Screven, who is the CEO of the Intra-American Investment Corporation. He has been working very specifically on transactions that are international in nature, around environment. And so I invite you to share the vehicles and the investments you've been working on to just expand the examples and the conversation before we turn to group discussion.
So first of all, thank you very much for the invitation. The light just went on, so I got all of your attention. I just wanted to share a bit of our experience. Should I stand up? Or? Yes, okay. Hi, how are you? So I wanted to talk a bit about our experience from the multilateral side and how blended finance has been used by multilateral organizations to expand its social and triple bottom line. One is blended finance has traditionally been considered as a way of de-risking transactions to be able to have a bigger impact. In our world, we normally use that as when the perception of risk and the reality of risk is different. And when we see that there are a number of transactions that we can't do for development purposes because of barriers or risk, is when we partner with foundations and governments and others to be able to actually provide financing in specific sectors. So I just want to use the example of how the IDB, the Latin American Development Bank, has used and worked with development, with blended finance in specific areas. So all the area of climate change, specifically renewable energy and energy efficiency, is it has been a big area, and I want to just give a few examples in that space. Another big area for us has been agriculture and forestry. Another area has been resilient infrastructure, and last but not least, gender finance. So all these areas have been areas where us as a group have used blended finance as a way to expand our mandate. How do we use this? As the example both Audrey and Kimberly has referred to, de-risking transactions, making transactions bankable and leveraging them. So just to share a few numbers, we have under management about $300 million of blended of concessional finance to apply to transactions. And what we've done over the last 3-4 years is for every $1 million or $1 of financing, we have been able to leverage $6. So today we have under management transactions in this space close to $2 billion we've done. And I want to use one example just to tee off the conversation in emerging markets. And an example is in Chile. In 2008 in Chile, we looked at an enormous gap in the non-conventional renewable space, specifically in solar, where only 20 megawatts of installed capacity was available in the market. And there were a number of reasons why this is, but we worked together with the national government to actually create a clean technology law, where actually transferred and changed the way the business is done. We partner with the Canadian government and created what we call internally the Canadian Climate Fund. It's a $200 million fund that we have, $250 million fund that we have under management today, and we've used that to gradually done a number of transactions, and today, 6 years later, we are the largest financiers in solars in Chile. And what has happened, not just because of us, but all the money we've poured into the market in this space, it's gone from 20 million megawatts to 770 megawatts, and the price has significantly dropped. So this is an example of how we've been able to cut those barriers that were appearing, both risk barriers, regulatory barriers, and other barriers that were in the market, and how we use that to expand specific areas. What's next for us? Just came back from Argentina, and there's been a launching of the renewable law in Argentina. So a lot of the conversations that we're having is how to use blended finance in that space. But places like Ecuador or Caribbean are other spaces in which we're doing. This is one example of what we've done, but as I said, there are spaces in agriculture, forestry, and gender where we have worked significantly, and I wanted to use that example. Thank you very much.
That's wonderful. And James, just one question while you're up there. You mentioned at the tail end Argentina, and you just came back. Could you also just comment on these blended finance transactions and the importance of the political and regulatory environment you're working on, especially as you want to have long-term outcomes through today's vehicles that you're constructing?
Yeah, so many of these investments, specifically in infrastructure, require very long-term patient capital. So we're looking at financings 18, 20 years. Regulatory certainty and sovereign risk are fundamental in all those structures. So when you have the uncertainty, imagine of 1-2 years, just imagine being patient for 19 years. So a lot of what we see now in Argentina with the new law happening, the new government, is actually building blocks for long-term financing when we did not see that. So that's an example of why personally we are, as an institution, as a group, very confident in everything that has been done to this. And we actually have been advising the government in many of those areas.
Thank you. Yeah, and so thank you very much, James. And turning now to the room, we really like to invite other examples people would like to share, not infomercials, please, but really the idea here is to create more of a learning lab. We are in an obvious era of testing different structures, testing different approaches, and learning from each other. What works and what can be replicated. So questions? Thank you. Up here. And a microphone will come to you. This is on its way here. Thank you.
Hi, thank you so much. This is a very interesting panel, especially for us. I represent a company called Water Health International. It's an American company, and I'm here with my colleague Jacqueline Lundquist. What we are trying to do is get drinking water to people who don't have it. We're working in developing economies. We've been working at the project level with blended finance now for some years, and recognizing that different environments that we work in, rural, peri-urban, or urban, have different economics. So our plants, which are very small water purification plants, have different economics in these various markets, and we try to finance them differently. What we're trying to do now is to set up a $100 million facility, primarily aimed at the Indian market. And a lot of the foundational capital for that will come from probably grant funds. But beyond that, we're using the same partners that we have on our projects and trying to provide some leverage financing for these projects. My question to the group is primarily around the percentage in which the proportion in which you try to blend, and how do you come to that conclusion on how much return do you need to leave and how much risk do you want to leave for the capital providers who are going to accompany this grant capital? Thank you.
Thank you. Yeah, that's a little art and science. Kimberly, can we hear your thoughts, since you were in the weeds of structuring and wrestling with probably that same question with the Healthy Futures Fund?
So I won't use Healthy Futures Fund as an example, but I can tell you many of our conversations start out like, how about you guys take this much and we'll take this much? So it's a negotiation. We have provided as much as 50% subordination and as little as 10. In the more extreme examples, we're taking real market recovery risk, namely in Detroit, where we're betting on 18, 20-year, 25-year, trends around recovery, which would allow us to essentially, actually, we took that risk with Jen. Yeah. So it's often a negotiation, but it depends on the extremity of the circumstances.
And one thing I've noticed over time, in particular your work, but others in thinking about blended finance, is this idea of things winding down over time, or the risk decreasing as some of the goals, financial or social, are met along the way. And it can be during the life of that fund as well. Is that something you see there is nimbleness in, and can be a way to kind of preserve some of your soft capital for other transactions?
It's hard to structure, but certainly in a number of transactions that we've worked on, we try to step down the level of credit enhancement as projects stabilize, as they season, because we believe that there's some evidence and a track record that can be relied upon. Sometimes that's possible, sometimes it's not. Sometimes you really actually can't see that seasoning until 10 or 15 years out, so it still is a very long hold. But we think that certainly is in our business interest when we can exit as soon as possible.
Mm-hmm. And I would just add in another feature, not proportion of risk capital necessarily in the fund itself, but a feature that came into play in Benefit Chicago was around liquidity. So it was a long hold that 15 years is the length of that fund, because the work needs that tenure to really have the financial and social results and outcomes that we want. So part of what MacArthur's capital did was also provide liquidity for the investors. And there is some structuring nuance to that, but a feature that can at times also therefore decrease the amount of actual risk capital needed, because it's actually mitigating a different risk. But that is a concern that the investor is bringing to the conversation. I believe there is a question in the back.
Thank you. Sorry, I'm sure we're going to get back to you. I'm Olivier Beur. I'm the founder of an organization called Man and Nature. We work in different countries trying to link, local development to conservation of biodiversity. And this is my point. We had the session where we talk about biodiversity. That we need to have sustainable development. We really need to protect biodiversity and the climate, etc., etc. And we're also facing, maybe more in Europe, a great matter of immigration, which is linked to poverty. So basically, investing in developing country is very important, and this is where we probably need the most, mitigated investment. But my question is, when we look at the project, we're working in 17 countries now. Usually the project we have, to support micro enterprises, it is very low. We're talking about the largest project we have, in Burkina Faso, which is helping to save the elephants. We're talking a lot about, bringing sustainable income to 950 women. The capital we need for that project is $300,000. And when I hear you saying, 350 million is a drop in a bucket, do you have any idea how we can go to deal with these little micro projects which are key into economic development in developing countries?
Yeah, wonderful question. I would actually even turn it over to the room. If there's anyone that feels that they have expertise in that area, feel free to raise your hand now. I would also just offer up in this situation, I think this is beautifully the role of intermediaries. Oftentimes, these structure funds are built not to lend directly to an enterprise or an organization, but to lend to an intermediary that potentially is in a geographic proximity to the business it then on-lends to. I always find it a little counterintuitive because I think in traditional capital markets, it's all about disintermediation. In our world of imperfect finance, intermediation, in fact, I see plays a really needed role in moving the capital in a way where it really fits the user most appropriately. And so speaking from personal experience, most of the lending that Calvert Foundation does is to intermediaries, is to funds that then on-lend to groups that are in country doing the work. And I think that really, as we've understood the piping that connects investor to end user of capital, I see there's actually 2 layers of intermediation within that middle piping. They are intermediaries that are interfacing with the Audreys, the capital markets of the world, creating these blended finance vehicles, potentially raising capital, considering risks such as liquidity, such as diversification, so there's not concentration of investments, and also size. For Audrey really to invest, $300,000 is not going to be achievable for her. The economics just doesn't work. But for her to be able to invest 20 or 30 million, that starts to make sense for her and the investor capital that she's moving behind her. So if you can imagine that on the left side, then I see another layer of intermediation that's closer to communities. These are groups that are really skilled at understanding the enabling ecosystem of the entrepreneurs, and then therefore providing technical assistance, as well as the appropriate capital tool for them to grow and succeed. And I will just offer one last observation. I think the other area that this movement and this growth of moving capital efficiently into communities is really blossoming now, is there's a lot more in-country, especially international, intermediaries emerging with local talent, with local knowledge of their communities that can really move this capital efficiently. So I think that's a good sign for future.
Jen, can I just throw one thing in that I think is totally implicit in everything we've been saying, but sometimes I think it's just worth saying explicitly is, as everyone gets so excited about impact investing and blended capital and capital stacks, I think there's 2 things that are just, important to remember. One is that, blended capital is not the best tool for every solution, right? And I think that we still always need to remember that social entrepreneurs does not necessarily equal social enterprise, which equals impact investing, which equals investment grade investment opportunity, right? And so there's some opportunities. I think absolutely philanthropy is the best and sometimes the only, really smart tool at a particular stage of development. And then, as things grow, they can start to become more of a blend or a handoff. And like, there's nothing worse than giving a social entrepreneur who needs a grant a debt instrument, no matter what the interest rate is, right? And then within the investor category, again, I think there's a huge disparity between the mission-driven investor, whether that's a philanthropy who has a sort of a pot of money set aside for sort of mission-related investing, or whether it's a family office who's decided to take a part of their own fortune that they have full discretion over and that they want to use as a catalytic source of capital, on up through the sort of institutional investors who have a fiduciary responsibility to get the maximum appropriate risk-adjusted rate of return, and or someone offering a product to a retail investor who does not have the high net worth to be qualified to be doing private equity or other, unusual kinds of structures. And so I think for us, kind of one of the biggest watchwords is just clarity around goals and alignment of capital, so you don't get disappointment on either the impact side or on the returns and the risk side.
Yeah, thank you. Up here in the front.
Thank you. Hi, I'm Doreen Shanaz. I'm founder of Impact Investment Exchange. I just wanted to share with you one of the instruments we just worked on, which is a blended capital, and interestingly, actually brings together a group of entities which are large and small. So it was our CGI commitment, and it's a $16 million bond. And I know it's not large, but it took us 2 years to put this together.
I wouldn't discount $16 million.
Okay, so the interesting thing was the fact that we basically pulled together 7 entities, 3 microfinances, and 4 impact enterprises who were smaller, fair trade, clean energy, but relatively small. And we created an SPV, and the SPV is the one which is basically issuing the debt. Now, this bond is actually now being guaranteed 50% pari passu by USAID and the Australian Development Agency, which is called DFAT. Now, the interesting thing with this bond is the fact that several things. One, it brought in impact enterprises, which individually they couldn't have raised this money. So we sort of, worked with the risk because the MFIs were large enough that they could do it. The second thing is the big focus was actually creating women's livelihood. So we created, through this bond, basically livelihood for 500,000 women. And the third thing is it's actually cross-sector and cross-country. So it's for it's Indonesia, Philippines, and Cambodia. So I think the interesting thing is, yes, it was painful, the first one, 2 years, but the next one will be much shorter, and we know it, and we're already sort of looking at it. It probably will be 6 months. And I think we probably need to look at things like this for outside the US, where we don't have a lot of this foundation money and all that, but really being creative. We had to be so creative in making this structure. And interestingly, though, now, as we're selling it, DBS, which is our largest regional bank in Asia, and ANZ, which is an Australian bank, they're selling it for us because we can't sell publicly. They're actually seeing it's the high net worths who are buying it. And also, this is actually a liquid instrument, so it'll be on the exchange, on SGX. So again, what's really interesting about it is it's not a fund, right? So it's actually a liquid bond, and it can be traded. So I think, again, I just open it up to everyone because it's the fact that how do we take things like this and create variations of it, right? Which, again, is quite different from what's happening in the US, because outside we don't have money like this. So we're much scrappy, It's much more scrappy. So, and just we have to be. So thoughts on the structure, what do you think? I mean, it's selling now, so, and any other pointers would be great.
Yeah, I think that's a wonderful example. Personally, we've been working on, over the last 6 months at Calvert Foundation, on an environmental impact bond. It will be issued by a utility company, and it will look like corporate debt. And so it is to your point, taking kind of a more traditional structure found in the capital markets and really making it work for good and incorporating the social impact elements as well. So I think a lot of great lessons and learnings there. Up here, yes, you wanted to follow up on that?
Yeah, I just wanted to add, actually, to both the comments here. There are a lot of, intermediaries in the finance world who are trying to do this thing. But from speaking from the perspective of a practitioner, which we are, the other gentleman who spoke about, doing a lot of work in different countries, also as a practitioner, rather than look at finding intermediaries, the other way that you can do it is if you have presence or scale yourself as a practitioner, you can try to aggregate that and raise the funds yourself. And you still need the finance folks, but at least you're a little bit more in control of your own destiny, because it's not always true that the intermediaries are where you have a desire to have an impact. That's number one. And I think from the perspective of the structure that we just heard about, I think multilateral development banks have a huge role to play, and and they're starting to get smarter about this. I think no, well, I think we have a few examples of banks that we worked with, and I think at the end of the day, I think what really grabs their attention is when you have a sustainable business model. If you have a sustainable business model, then you can use leverage, which is what they are interested in giving out most of the time. And you can then supplement it with some grant funding and try to come up with a blended finance. So there are different models everywhere, I think.
Can I just jump in for 1 second to underscore the importance of creativity, which I think is desperately needed in many of these problems, but also to say that there's a companion to creativity, which is called practicality. And in philanthropy, I can tell you, because we can take rate, term, risk, we can do a lot of unusual things. There is a pull which sometimes has us creating unicorns. And we need to make sure that, the structures that we all create don't just get something over the line once, but get something over the line. So we have tried to kind of hold ourselves accountable for not too many moving pieces, because we have one transaction in particular where I think we were trying to hang too many Christmas ornaments on the Christmas tree, and now the tree's, bending like this. So.
Up here.
Yeah, Joy Anderson, Criterion Institute. We work on gender lens investing globally. And I wanted to actually build on that comment and come to a question. So I was struck by the de-risking definition of actually getting to the difference between perceived risk and the actual risk. And one of the things we see in gender lens investing is how often people are just getting gender wrong, right? They're either not seeing risks that are there, or they need to see it. And what I like about the examples you gave is, and I think this for me is, I've been sort of hanging out around blended finance for a long time, but really want to reinforce that if you change the underlying analytics of the calculation, because you show what's possible with, throwing your capital in, you're changing fundamentally the analytics across finance, right? Or trying to, at least. And so I guess this is my question back. What work are you doing on that second level of saying we've proved that it worked here? Can this actually start to change either how we benchmark or the underlying calculations that go into the next mainstream calculations in Morgan Stanley or wherever?
No, that's a great question, and I think that actually is exactly where we are really trying to go, which is, I think, that as people get more understanding of how environment and social and governance issues, they're not extra financial issues that are somehow on the side, outside the fortress of financial results. They actually are factors that can very materially impact financial results. And so, a couple of things is that actually at Morgan Stanley Equity Research, they've actually published a few reports around embedding sustainability into valuation. and actually going industry by industry and saying for each industry it's different, right? For telecom versus extractives versus services, there are different environmental or social factors that can actually have truly material impact on the valuation of a stock. And once you are aware of those, I think it's very hard to ignore those, right? Because how could you not factor in the value? I think really interesting to your point specifically about gender lenses, that our equity research colleagues recently did a study on gender and looked at companies that scored high in terms of sort of getting it right on gender. And again, not just how many board members they have, but all sorts of gender-related practices. And lo and behold, they found that there tends to be a correlation with higher productivity, with higher HR retention rates, with more productive workforces, and also over the long term, you have actually lower volatility in the stock price and higher ROE. Because a lot of times what gender lens or many other things around inclusion, diversity, or environmental practices tends to give you a lens actually into quality of management. So I think that what we're seeing now and why I think there are so many interesting conversations that span from social entrepreneurship to mainstream capital markets, and it is a broad span, is that we're starting to see that these things are actually very, very much connected and very much need to be more and more integrated into core financial, traditional capital markets decisions, as well as into mission-related investing.
Yeah, in the back over here. Thank you.
No, it's not.
A little further. Yeah. Good thing.
Thank you very much, Jen. Appreciate it. You spoke earlier about trusted intermediaries and their role. By the way, Mark Orlowski, Sustainable Endowments Institute, project of Rockefeller Philanthropy Advisors. You spoke about the role of trusted intermediaries and intermediaries playing a role in facilitating transactions. So we're actually working on a project along those lines. We work with over 300 universities and other nonprofits in all 50 states across the country around energy efficiency. But what we've seen in recent years is that the most sort of needy nonprofits, the under-resourced nonprofits, are oftentimes being left behind when it comes to deploying capital and upgrading their facilities and reducing their energy costs and their carbon emissions. And so we've been developing this program we're calling the BEST Fund, which stands for Building Energy Savings Together. And the short idea behind it is to basically serve as a trusted intermediary to be able to deploy philanthropic capital and other capital into these nonprofits in an off-balance sheet way through an energy service agreement model so that they're not having to take on yet more debt. And so I'm wondering, we've done our first pilot project just over the border in New Jersey with a faith-based institution. But I'm wondering, besides doing more projects to start to sort of scale up, I'm wondering what other advice you have to us as we to look to expand and scale this.
Any thoughts?
Well, I think there's always the data question. And, unfortunately, an N of 1 is often kind of too small. But so you need, that inaugural investor to go with you, I think, a couple of times in order to kind of aggregate this project. So, I think for us, and we're certainly familiar with this really good work, it's really trying to figure out when are things past incubation, but not yet to that next plateau. And that's kind of the sweet spot for us. Because, our money is designed to take risks. That's what we're supposed to do. We actually have very rigorous conversations internally about, are we taking enough risk and how will we know when we get to that point? But it's not an exact science. It's really an art trying to understand when there is enough of a proof of concept that we can put our capital in with hopes that we can get to that next place. And when it still really is really experimental and probably should be funded with grant funds until we have that that evidence base.
Yeah. I think there was a question over in this area. There we go. You bet.
My name's Ted Grant. I'm with an organization based in The Hague called CourtAid, which has been working in the most fragile context for over 100 years. We're looking to take on a really important challenge, like everyone, I guess, has important challenges, but the notion of economic development, job creation in the most fragile context. And as we've seen in the last several years, particularly with refugee crises and so forth, the notion of not only how do you address refugees when they're landing, but how do you deal with economic opportunities, particularly for women and youth in these countries, is really challenging. And so the approach, Coordate has fortunately benefited from the impact investing for 15 years now, and over the last 2 years has actually segment their foundation-related work from their investment work, setting up really a professionalized money management, investment management shop inside of it. And the two work side to side, the investments and the foundation side of it. And the model that we have is we've created a fund that we're actually starting to raise money for, is called the Stability Impact Fund in Africa, which is focused on around 6 countries: Sierra Leone, Nigeria, South Sudan, Ethiopia, Burundi, and a couple others. And the concept is to kind of help shift the continuum of economic development by taking this fund, which is a debt fund, be 40 million euros, and go into some of these countries, and before do so, take grant-related capital, go in and actually train the entrepreneurs in business development services and provide them on-the-ground training for 6 months as a full curriculum that's developed. And it's through that process that you really get to know those that have that entrepreneurial instinct, that are really getting how to run a business and grow a business. And then after that period, and it also helps on the due diligence side of it, developing that on-the-ground presence and networking. Then on top of that, we go in with investments, loans basically, and we do that across a continuum through micro enterprises to very small and SMEs. And the idea is to help graduate those up into greater growth and profitability. And then once the training's done and we've provided the investments, we actually have someone on the ground who provides ongoing coaching and development for those entrepreneurs to make sure that when they hit those tough spots or those inflection points of growth, that they can rise up to the occasion. And so we're excited about it. We've done it in Sierra Leone, and the value of that, of having someone on the ground, is that you also have staying power in those countries as well. And so Coordate was there before Ebola came, and then during the crisis, the on-the-ground person did not leave. They stayed there. They maintained their presence. It was instrumental in helping to manage the investments by postponing interest payments on loans for a period of time. Came through the crisis, and all those enterprises are still in effect. So I share that only as, I think, a point of hope about these countries. And the challenge, the interesting part of that is we're actually starting to raise money for it. And I think to the point that, Audrey, you were bringing up about kind of stack capital, I mean, the architecture that we've developed is looking at institutional money as to provide anchor investment. Coordate will be in for 20%. Then on top of that, to layer foundation-related money and then move up into high net worth individuals, family. And we're finding that it's interesting, finding that the receptivity, because the focus on fragility is so high right now, is the institutional money is coming in very quickly. So our challenge is going to be, how do we secure the grant funding to actually catalyze, because the more training we can do, the more loans we can give out and build the pipeline. So any thoughts, particularly on the business development services and grant funding, would be helpful, or any other insights?
Yeah, thank you. You know, I think you hit a chord with your last comment there, the limited resources around grant funding. And just in general, we heard Kimberly and Audrey both mention, you know, soft capital is part of the, I would say, scarcest resource in a lot of these blended finance vehicles coming together. As we wind down, you know, Kimberly and Audrey, just knowing the need for more blended finance to move into communities to really meet some of the challenges we have, and having been through quite a few transactions yourself, thoughts, opportunities that could accelerate these blended finance vehicles coming into being, whether it's being a practitioner and lessons learned, or just observations of the field, unlocking future soft capital, or any thoughts you might have around that.
I guess I'd say, two things. One is is really, I think, one of the points that came up earlier is figuring out how to build that table, right? I mean, being able to tap into that collective intelligence of what are the different resources and how do we pull in government, development bank, inspired philanthropist, high net worth individual, and then where appropriate, a return-seeking investor. That ability to do that sort of cross-sector conversation, I think is so critical, and I think that's where we started our conversation, right? Is if you don't have people who understand, and I know that anyone in this room who's ever made a pitch in their lives to a philanthropist and an investor knows that you almost have to like pull out like the processing chip for investor speak and put in philanthropist speak and then swap it. And I know some people who have two different decks, right? They have the impact investing deck that they take to their mission related investor, and they have the returns focused deck that they take to their traditional investor. It's the same product, but they have to talk about it differently. So I think that ability to have that conversation and then bring that table together. Right. And then I think finding, you as the philanthropist don't want a high rate of return, but how do we figure out what's a return, an impact return for you versus what each person needs? So I think that the cross-sector language, the clarity of language, and the collective experience that it's not only okay, it's actually the only way it works, that Kimberly wants entirely different things out of the Healthy Futures Fund from as a return, if you will, than what the investors are seeking in it. And I think that's probably one of the most important things. But again, as you said, just not having the mismatch of when philanthropic dollars are used. The last thing I'd say is, I remember early on we were having one of these conversations about the Healthy Futures Fund, and I came out with this sort of grandiose statement that said, this would not have been possible to do these kinds of projects without the full partnership. And I think actually it was probably Rip, head of your foundation, who said, actually, that's not true, Audrey. Philanthropy could have done this alone. However, right, it would have taken us $100 million of philanthropy to do what you would have done with $100 million, right? And the whole point of this is, with the orders of magnitude less of philanthropy, you can activate this other money, and therefore how can you make the precious philanthropy dollars go as far as possible?
So I thank you for the example, because I think it's exactly those types of situations where actually grants and investment dollars are working side by side, which is the pathway forward. I mean, one of the pleasures of my job is that, I have colleagues who do have grant dollars. So when there are extra things in a transaction that we want to learn or can't be financed or capacity that needs to be built on the ground, we can supplement our investment dollars with grant dollars. And every chance that we have to talk about that, we really do. But I think for all of us, for the field, I mean, when Jen started with $2.5 trillion to implement the COP21, I mean, there is no way forward other than to figure out how to harness the markets. And I think that philanthropy is coming to that point, understanding that with we have the capital that can be deployed in many different instruments. By augmenting our skill sets, by expanding the spectrum of partners that we engage in, by being singularly focused on where capital barriers are that we can take down to allow capital flow in, that's the path forward to that kind of number. I mean, otherwise, we're all kind of, pedaling wildly on our bikes. But, it's when we start to harmonize and synchronize those capital sources, that's when we're going to get someplace.
Well, thank you both for sharing your wisdom, your expertise, and your learnings. And thank you to everyone in the audience, too, for sharing. We have the room, I believe, for some time to network and talk more. That's part of how we're going to make it, is to learn who our dance partners are and how to really find a way forward together. So thank you, and enjoy the rest of your night.
Thanks very much.